Waiting for the right real estate market is the smartest move. Or is it?
Moving forward with the Dekker team. Moving forward together with the Dekker team.
We're delighted to have created for you free access to over 736 Life's Inside Track episodes where we share insider tips, making house home, and building wealth wisely through real estate. Waiting for the right real estate market. I could have a lot of money if I collected money every time somebody said that to me. I'm just going to wait.
For the market to be better.
For the market to be better from my perspective.
Mm-hmm.
And what does that really mean?
Good question, right?
I think it costs you a lot of money, actually. And it costs.
Mm-hmm.
That timing your life around the market rather than timing your life around your life. Because what's a better market?
Mm-hmm.
Is it one where you have saved up more down payment? Well, then that's more about you. Is it one where the prices have dropped? Or is it one where the interest rates have gone down? Because if the interest rates go down, the prices usually go up.
Yeah,
and the prices go down, often the interest rates go up. So how do you figure all that chaos out?
Yeah. Many a buyer has waited for interest rates to go down, not recognizing that they buy, but then the price has gone up and their payment ends up being the same amount. And they've got more mortgage to pay off and more down payment to give because the price was higher.
Right. Whereas if they had bought when the interest rates were a little bit higher, they would have had less down payment. Like, let's make this tactical.
Mm-hmm.
They would have had less down payment to give because they would have paid less. And when the interest rates went down, they would have benefited from that decrease in interest rate, and they could have kept their payments the same and paid off their mortgage quicker, sooner, faster.
Yeah, when interest rates were a few percent higher than they are now, we were saying, date the rate, marry the house. And it's so true, right? Because if you took variable rate, you rode that puppy down. If you took a 1 or 2 year expecting rates to come down, when you renewed, the rates were lower. Or they're going to be lower. So it's what do we do with the market more than what it is, what's the market doing?
Right.
Does that make sense?
It does.
Because the market we cannot control.
I haven't figured out how to control it, even though I've been at this 37 years. No control of the market.
No.
What I have figured out, though, is how to control myself.
Control your actions, control your mindset. Control your research, figure out what you're going to do, and look at history and look at your time frame. Like if you're thinking, oh, you know what? Housing prices may come down. I don't think they will, but let's say you're thinking, oh, they're going to come down. It's a bubble. They're going to come down 10, 20% or whatever, right? The point is, look at how long you're going to plan to stay in the house. If it's a 2-year plan, maybe buying real estate's not a great idea.
No, we're not saying buying real estate is always a good idea. Sometimes it's a bad idea for you, given your situation.
Yeah.
And in Clarity Call, we'll reveal that.
Absolutely. But then if you stretch things out, if you look at 5, 10, 15, 20, 25 years, the length of time it takes you to pay off the mortgage, historically, what's happened with the value of the house?
Well, doubled or tripled in that length of time.
4 times, right?
Yeah,
and the time it takes to pay that mortgage off. And we might say in another show, maybe you don't want to pay the mortgage off, but that's another story.
That's an investment conversation. That's using your money to make money.
Yeah. But we know historically over the long haul, just like the stock market, historically over the long haul, it's gone up. Well, historically, real estate, over 5, 10, 15, 20, 30 years ago, it's gone up an average of about 5% per year. And that doesn't sound like a lot, But this might be a good chance to talk about leverage just for a second, because you're only putting in 5 or 20%, or maybe you've got more down payment.
Maybe 50%?
Yeah, maybe you do. But it's still leveraged, which means if you put 50% down, you bought a house for $600,000 and it went up 5%, you only put 300 in, so you made 10% on your 300, because 5% of 600 is 30,000. That's 10% of 300. Now, if you only put in 20% or 5%, it's even much, much more rate of return. And that's why we call leverage. That's how it builds wealth when you're sleeping.
When you're sleeping. And when you're awake.
Yeah.
It actually doesn't only work when you're sleeping.
I know,
It
but it's kind
actually
of fun
works-
to think that.
I know. Your head can be on the pillow and you're still making money. And I can be at my day job making money. Or I could be volunteer. I could be serving somebody and my money is making money. I love giving my money a job rather than having a job.
Yeah. So you like giving your money a job rather than you having a job.
Only.
Yeah. That's a great.
Both kind of works well, right? Give your money a job
And if you-
and safe leverage. We're not talking reckless again.
No.
It's all about within understandable, confinable frameworks.
Right. And remember that your job is an investor in your future, right? It's not just to live on. It's the investor that puts money away, seed money, to build wealth for future years and future generations. So CMHC said that interest rate changes alone are not the primary driver of long-term housing outcome. So it's supply, demand, household readiness. In other words, ready to purchase matters more than the interest rate. And by the way, interest rates are pretty great right now. It's not.
We'll have lots of arguments with people about whether they're fantastic or not. I can tell you, having been in the real estate market for 41 years,
living in real estate
and owning real estate for 41 years, the interest rates are some of the, in the big picture, the lowest I've experienced. I mean, they're not the lowest, but they're in the bottom 20% of all the interest rates I've experienced in the last 41 years.
Yeah.
So if you're talking to a younger person or a person that's newer in the market, they don't sound great. Talk to somebody that's been owning real estate for a long time and they're fantastic. And then you may say, yeah, but the house prices were lower. Yes, they were. And that's what we talked about at the beginning of the show is rates go up, prices come down relative to what's happening in the market or vice versa.
Yeah, and it's interesting. We see change in the rates affect people's buying decisions. Like when rates are on the way up, people are anxious to get in quickly. When rates are going down, they're stalling, trying to wait for them to go down. It doesn't matter. Are you ready to act? Then the best time to act is actually
Now, if you're ready.
Yeah, and then now. So confidence comes not from always being right, but from not fearing to be wrong. That's Peter T. McIntyre. And this is where people confuse market timing with life timing, which you talked about earlier. And we're going to expand on that in segment C. And we're glad that you're joining us because as we make your options clear, your wisdom will flow.
Moving forward with the Dekker team. Moving forward